Let's be honest, the financial markets can feel like pure chaos, right? It's like a storm of numbers and breaking news that seems designed to make you feel lost. But what if you had a way to find your true north, even in the middle of all that noise? Well, that's what we're doing today. We are building an investor's compass, a resilient philosophy to help you navigate the madness and find your way to solid ground.
Here's our game plan. First, we're going to tackle the market's wild emotions. Then we'll learn to see its hidden rhythm. We'll load you up with a playbook of powerful tools, look beyond just stocks, and finally, we'll sharpen the most important tool you have, your own mind. So let's get started and confront that chaos head-on.
Okay, so first things first, we have to get to the heart of the problem. You see, the market isn't some calm, perfectly rational machine. Nope, it's more like an emotional roller coaster, and it's driven entirely by human psychology.
This line from the book, The Intelligent Investor, it says it all, doesn't it? The market has this habit of taking small, everyday issues and blowing them up into these massive, full-blown panics. It's basically a drama machine that just amplifies fear and greed, and that's exactly why we see these huge, dizzying price swings.
So why? Why does it swing so much? Well, the answer really lies in this simple but incredibly important distinction. You have to realize that in the short term, the price of a company's stock and the actual value of the business itself can be two totally different things. One is driven by fleeting emotions, and the other is driven by solid fundamentals. I mean, just look at Amazon. In 1 year, its stock price bounced from around $1,377 all the way up to over $2,000. That's a swing of nearly 50%. Now ask yourself, did the actual business of Amazon, its warehouses, its services, its customer base, really get 50% more valuable and then 50% less valuable in just a few months? No way. Of course not. That's not business reality. That's the market's emotion on full display.
Okay, so we've established the day-to-day is pure chaos. But if you zoom out a bit, you start to see something else, a pattern. See, economies and markets move in these broad, pretty predictable cycles. It's a lot like the 4 seasons of the year. And understanding these seasons, that's our first step toward building a real strategy.
You can really see this rhythm when you look at which parts of the market or sectors do best at different times. For example, when the economy is shrinking in an early recession, you see money just flood into what we call defensive sectors. Think about it, things we need no matter what, like healthcare or consumer staples. But then, as the economy starts to recover, investors get bolder and they rotate that money into aggressive growth areas like technology.
And knowing this difference is absolutely crucial. You could think of aggressive sectors as your fair-weather friends. They're amazing when the sun is shining. Defensive sectors, on the other hand, they're your shelter in a storm. People are still going to buy toothpaste and pay their electric bills even in a recession. So knowing which season we're in helps you decide whether it's time to go for growth or to seek out some safety.
All right, now that we kind of get the weather report, we need the right gear. Let's fill up our toolbox with the core principles that legendary investors use to spot truly great businesses, no matter what economic season we're in.
Warren Buffett's most famous idea is probably the moat. And it's a great visual, right? Just like a real moat protects a castle from invaders, a business moat protects a company's profits from all its competitors. This could be a brand name that everyone knows, like Coca-Cola, or a patent on a breakthrough drug, or the network effect of a platform like Facebook. It's that special something that gives a company a durable edge. Now this is the value investor's seatbelt, airbag, and helmet, all rolled into one. A margin of safety just means buying something for way less than you think it's actually worth. It's like buying $1 for 50 cents. That way, if you're wrong about the future or the economy just goes haywire, you've got this built-in cushion that protects you from taking a huge loss.
So how do you actually find these companies with those wide moats? Well, this framework here, Porter's 5 Forces, is like your own personal X-ray machine. It lets you analyze the entire structure of an industry. By understanding these 5 different pressures, you can figure out how profitable that industry is likely to be, and more importantly, you can spot the companies that are in the strongest position to succeed.
And this quote just gets right to the heart of the playbook. The goal isn't to perfectly predict the next recession or who's going to win an election. The real goal is to find businesses that are so exceptional that they can thrive no matter what's happening in the world. It mentions 100 baggers. That's just investor slang for a stock that could return 100 times what you paid for it. Think about it. During the 2008 financial crisis, while most companies were sinking, a company like Dollar Tree actually grew. Great businesses make their own weather.
Now, a truly strong financial fortress isn't built with just one material. Stocks are a fantastic engine for growth, but a really resilient portfolio often includes other things. So let's expand our toolkit beyond the stock market and look at other ways people build wealth, specifically one powerful alternative: real estate.
Robert Kiyosaki, who wrote Rich Dad, Poor Dad, has this completely game-changing way of looking at things. He says, forget the old textbook definitions. An asset is simply something that puts money in your pocket. A liability is something that takes money out of your pocket. That's it. It all comes down to the direction of the cash flow. A rental property that pays you every single month, that's an asset.
So let's follow that logic. If an asset puts money in your pocket, is the house you live in an asset? Well, every month it takes money out of your pocket, right? For the mortgage, for taxes, for insurance, for repairs. It doesn't generate a single dime of income. So according to this cash flow rule, your primary residence is actually your biggest liability. It's a really controversial idea, but it's powerful once you grasp it.
And this is how savvy real estate investors use that principle to build their portfolios. It's called the BRRRR method, and it's a system for acquiring these income-producing assets. The real magic happens in that refinance step. By renovating the property, you increase its value, so the bank lets you pull your original cash back out. Then you can repeat the whole process on another property. You're effectively building a portfolio of assets with very little of your own money left in each deal.
Okay, we've looked at the market, we've looked at the economy, we've looked at different assets. But the single biggest factor in your success or failure, it isn't out there. It's right in here. Your greatest opponent more often than not is the person staring back at you in the mirror.
This is such a perfect analogy for what happens during a market panic. When stocks are crashing, the financial news just turns into this endless chorus of the sky is falling. And the real danger is letting that widespread fear crawl into your own head and cause you to panic and sell at the absolute worst possible time, right at the bottom.
Now let's look at a different kind of danger, something more subtle. It's called the turkey problem. Imagine for a second that you're a turkey. Every single day, this nice human comes and feeds you, day after day. Your confidence that humans are your friends just grows and grows. Well, the day before Thanksgiving is the day of your absolute peak confidence. And of course, it's also the day of your greatest danger. The lesson for investors? Just because something has been safe for a long time doesn't mean it will be safe tomorrow. A long period of calm can be hiding a huge, unforeseen risk.
And these right here, these are the mental traps that we all fall into. It's just human nature. We follow the herd, we look for information that proves we're right, we let fear and greed grab the steering wheel, and we foolishly assume that whatever just happened is going to keep happening forever. The first step to winning this inner game is simply being aware that these biases exist in all of us. All right. We have covered a lot of ground here. We've stared into the market's chaos, we've decoded its seasons, we've gathered our tools, and we've faced our own psychology. So now, let's put it all together and actually forge your personal compass.
Let's map these ideas to our compass. Think of north as your true direction, which is always value, knowing the difference between an emotional price and a real business's worth. South is your foundation, focusing on quality businesses with wide moats and always buying with a margin of safety. East represents the changing environment, understanding the economic seasons to know when to seek growth or safety. And finally, West is your inner world, mastering your own psychology, because that, my friends, is your ultimate edge.
Look, the journey from being lost in the chaos to building a fortress of financial security, it doesn't happen all at once. It starts with a single, deliberate, and informed decision. The compass is now in your hands. So the only question left is, which direction are you going to choose first?